China has sold its first negative yield sovereign bond in the Eurobond market, and it garnered huge interest from European investors. China's 5-year bond has a yield of negative 0.152% as per Reuters. So what does it mean? It means the bond holders paid more today, that is 100.76, to receive par amount of 100 at maturity. As per Financial Times, this excludes inflation and could possibly lead to a lower real yield till maturity. Apart from this, two other securities were issued, the 10-year and the 15-year bonds, that will bear positive yields of 0.318% and 0.664%. With this, the Euro bond market becomes accessible to Chinese companies. Why was it still attractive to the investors? Sovereign bonds are generally backed by the country's central bank or the government. China's credit rating on its 10-year sovereign bonds is A+, and it yields 3.35%. On the other hand, the European Central Bank is offering rates between negative 0.5% and negative 0.75%. So it essentially means that the relatively lower rates in Europe made China's low rates attractive for European debt investors. The offering drew in about 18 billion euros worth of orders for 4 billion euro of bonds. That's not it. Investors are relieved by China's quick recovery as the pandemic again waves through Europe and other regions. As per experts, negative yield bonds are sometimes used as a hedge or safety during times of economic uncertainty. In the Eurozone, investors are paying to hold almost all short and medium-term sovereign bonds. Moreover, the pandemic has pushed global rates lower. More lockdowns could further pressure them to the south. In August itself, the Chinese economy showed signs of being back in the black as per its exports data. In Q3 2020, while countries clocked negative growth held back by a cannonball of COVID-19, China's GDP expanded by 4.9%. It therefore appears to be a stable economy during COVID-19 crisis. As per an analysis by the Harvard Business Review, the Chinese state and its subsidiaries, including public banks, have lent about $1.5 trillion in direct loans and trade credits to more than 150 countries across the globe. As per the Washington Post, China has foreign exchange reserves of over $3 trillion. The issue of these securities diversified China's international investor base as it has been strengthening its capital market over the years.